Can everybody see that?
Yep.
Get a nod. Great. Thanks. Okay. Got it. All right. As most of you know, I'm Jonathan from Simply Finance. I'm a mortgage advisor, and I'll give you some background on me and then what's happening in the industry in general at the moment, because there are some changes coming, as I mentioned before. That's interesting. There we go. I've had about 4 career changes in my life, and I started life as a training manager at Foodtown supermarkets when they were around. And it would have been a great job if I'd stayed there, but my parents were hotel managers, and I was raised in hotels around New Zealand, so I got to live in the biggest house in town, in different places, and really salubrious locations like Dargaville, Kaitaia. The great one was Rotorua, which was one of my favorites. It was a beautiful hotel there that burnt down in the Christmas of '73. I was at boarding school in Auckland by that stage because my parents wanted me to have a stable secondary education. And so when I was a training manager at Foodtown in Auckland, I said to my parents one day, I'd want to get in the travel industry. And my wise mother said to me at that time, and I should have listened to her, she said, "Son, people don't always need to travel, but they always need to eat." And if you look at how supermarkets have changed these days, if I had stayed there and actually become a Pack and Save owner or a New World franchise owner, I'd probably be a fairly wealthy person like most of them are these days. But hey, I had so much fun in the travel industry. From there, I went into the IT industry. Computers came along and I got involved in that and ended up getting made an offer by the business that was working with our travel company at the time, and went off into the IT industry for 12 years. Distribution systems, different travel systems, all sorts of things. But travel was in the blood again, and I returned to the travel industry in about 1998 to a little business called Travel Arrangements, or Tal Pacific as they became, and they were a Pacific specialist wholesaler. So I got to go to a number of the Pacific Islands on different occasions, and ended up being general manager of that business, and then moved on to House of Travel as general manager there and their wholesale product team as well, and had some really great years at House of Travel. I think that's where I met Christina. Christina and I have known each other for a few years in that industry. And then from there went on to Air New Zealand Holidays, when they used to have holiday shops and an arm like that. Dear Christopher Luxton decided he should close all of those. So that's why you don't see Air New Zealand holiday shops anywhere around the country anymore, because they've all been closed and they're focusing back on their core business. So it's been a bit of an eclectic career. And then after multiple, going through restructures in the travel industry, about 7.5 years ago, I exited and became a mortgage advisor. And I am so glad that was perfect timing. I would hate to be in the travel industry now. It's not one. So it's completely changed. And I've been investing in property for 20 years, over 20 years. Made money in property and I've lost money in property. In the GFC, we lost a lot of money because of buying things that were coming out of the ground that didn't come out of the ground. And the world went into cataclysmic meltdown financially. So we lost a bit of change back then, but recovered. These guys are my fabulous sons, and I know everyone talks about their children in glowing terms, as we should, but I got to tell you, these are 3 wonderful human beings and a real blessing to my life. So Michael's my eldest, the right-hand side picture. Isaac's my baby in the middle, and Jerem's my middle child. They all got married, my claim to fame, in 2017, every single one of them. And first wedding was in February, which was Jerem in Nelson. The second wedding was in Auckland, which was Isaac it was in March. And then we all went off to Poland in July for Michael's wedding, and had a fabulous time over there. Believe it or not, all these 3 lovely ladies are all in the medical field. So one's a doctor, one's a nurse, and one's got a PhD in psych. So as far as old age is concerned, I'm absolutely covered. I've got all the bases sorted for when things happen. And that's my beautiful wife on the right-hand side. And we will hopefully, Lord willing, celebrate 40 years next year somehow. So she needs a medal without question. And the other reason for my joy these days are these three. So fast forward to today, that's Indiana on the left, Hadassah in the middle, and that's little Jack on the right, who was born at the start of this year. And you wonder why Hadassah is called Hadassah. It's a Hebrew name for Esther in the Bible. So we don't have Jewish blood as far as I know, or Arab, or Jodine's part Arab, believe it or not, historically, but it's a name she's been given, which she'll have to explain the rest of her life. The other thing I'm involved in outside of mortgage advising is I'm an elder in a church called North Cross on the North Shore, where I've been for a long, long time. One of the things we do each year, and this year we intend to do it, is what's called a Christmas drive-through, where you can, it's a light show basically, and we have thousands of cars that line up along East Coast Bays Road and come through in the evening, and there's live people there, so they're all from the church dressed up. We've had sheep in the past. We do coffee inside, and it's just a fantastic light display with LED lights and all sorts of things. A bit like is it Richmond Road? I think over in the city they do it as well. We do obviously a Bible theme type thing, but it's one of the things we do each year, as well as a bunch of other things. Apart from that, I'm also on the board of a charity called Child Rescue, which focuses on rescuing children out of sexual slavery around the world. Jerem, my middle son, he was involved in that for a period of time as well. And they don't operate in New Zealand, they fundraise here, but they operate in a lot of the Asian countries and rescue kids as young as 3 years of age up to girls in their 20s and boys, believe it or not, to get them out of that. It's a horrendous blight on society that is just not going away. But there are people out there, apart from Child Rescue, there's a number of mission agencies or charities trying to end this in the world as quickly as we can. So what's happening out there in the world of finance? Well, I can tell you in the property market, there's three types of people. There's the dreamer, who goes, if only maybe, I'm one day I'm going to buy a great property, one day it's going to happen. I'm just hopeful. I don't know, it might. There's the complainer. They're not always Australians, sorry, Kaz, but there's the complainer, and they'll moan and groan about the property market and go, it's unfair, it's overpriced, I can't save, everyone's mean, no one's helping me, and it just won't happen. And then there's the realist. And they're people who actually make a plan, organize their finances, look at what they can do, and try and take steps to actually getting towards the property they want to buy. Just starting is the key. And often there's more than one complainer, I'm afraid, when you look around the place. So why is all this happening and what's going on out there? Crazy stuff in over the past few years, as we saw, and not just because of COVID. COVID accelerated some of these changes without question, but these were happening for the past 5 years as the markets warmed up because of massive influx of immigration into the country for a start. But the value of the housing market has surged, obviously, even more so in the last few months of late last year and into this year. $1.51 trillion worth of property now around. So it's a big market, and the banks love it because it means they are going to get a lot of money off mortgages. They like mortgages, they're safe, and they make them a lot of money. In Auckland, 50% of listings are now over $1 million. You can find property below $1 million, quite reasonable property. It just depends what you want and where you're buying. Wellington's a little bit different. Christchurch is a softer market at the moment still. There's still bargains to be had down there, but that is likely to change in the next little while as well. And just a stat from last year, it just shows you how things have really started to romp when you compare some October stats. And this October, I didn't have those stats, but they would have gone up again without question. So they talk about household debt in terms of servicing mortgages, and we are obviously falling way behind our ability or the amount of money it takes of our income to service our mortgage debts. And you can see that the red graph heading down on the right hand side there. Income is the blue lines to the right, and you can see we've tracked down since 2008, where it was quite affordable in terms of your debt to income ratio of your income to pay for your mortgage, and we just keep tracking down at the moment, and it's getting worse. I think New Zealand's about 11 times income now to get a mortgage and buy a property. 37% increase in rental in the cost, in the price of property in the past 12 months. 37%, but even more so, this is the crazy part. In the last 10 years, it's up 160%, and the last 30 years, it's up 600%, which just shows you why people are buying property and why people invest in property, because it's a really good asset class to actually be owning and getting value in. So why is all this happening? Why have prices gone up so incredibly over the last few years, and what's been driving it? And these are particularly probably COVID reasons in some ways, but it was happening prior to this. And I've seen several stats. I've seen 5 billion, 10 billion, and 15 billion of travel that hasn't happened, and people wanting to use that money elsewhere. So that's been one reason. Everyone stayed home or had to stay home, and they've used the money elsewhere. A lot of Kiwis returning to New Zealand, and they're still returning. They're not going away. Potentially Australia will grab a few of our people in the years to come, because they're offering higher wages and some better conditions over there, and unless you want to go and catch COVID potentially. There's a lack of housing stock still, and we just haven't built enough. We haven't got enough. We haven't got enough property in the right place. If you want to buy an apartment or rent an apartment, you could do that tomorrow in the CBD quite happily. But in terms of property around the central city, there just isn't enough at all. Even though we're building it, we're not building infrastructure fast enough either. The cost of buildings materials and the supply has become a massive issue. And I've had one client whose property has gone up 160,000 in the build cost in the last year. And that was when they had a quote a year ago, and they finally got the consent to start, and the price has gone up. All the suppliers have a problem. There's problems getting materials into the country, and that's what's driving house prices as well. Lockdowns have generated change. People wanted to move. They realized they couldn't work from home together around the same kitchen table. They realized their kids were driving them insane because the house wasn't big enough to have school and also work at the same time. And sadly, there's been an increase in divorces too, more than likely, because people realized they really did spend too much time together. Historically low interest rates. So that's been another benefit, and I'll show you later on that rates have actually fallen over the past 30 years. There's been on a downward trend. That's about to change. So there's money looking for a home. People used to invest in the share market, and they still are, and that's had a bounce from COVID. But we've all upgraded our cars. Some people have. They've changed houses. They've added the spa pool. They've done everything they can with their money, and they still have spare change. So people are looking at investment properties as well. It's become an asset class property. The government for years has been telling us to prepare for retirement, get ready for it. And so people looked around, where can I get some money for retirement? Property is a logical one, that if you can get an investment property or two, potentially pay it down, and you'll live off that rent in your retirement, because National Super is not going to cut it. So having told us for years to do that, the government's now trying to stop everyone buying investment property, because they see that as a giant evil in terms of driving prices. Building fees, council are levying high fees now to do building, because they need water retention tanks. They charge resource consent fees. There's all sorts of things in there now that will drive up the cost of a property. Dwellings have got bigger. You need to drive around Millwater to see that property's had a bit of a boom around there in terms of size. And the rise of employment, there's more people employed now, so it means more people earning income in order to be able to purchase property. So those are just a few of the reasons. why things have gone up. And if you look at Auckland, where the pressure point is, we're expecting to grow the city by another 650,000 people by 2048, which is I don't know where you're going to put them. We're on a small isthmus. Gosh, that's a mouthful to say at this time of the morning, but we don't have a lot of land necessarily. We've got to push north and south, or up, and condensing has been the focus now. So that's one element, but then you're going to create other issues, social issues around that. And you only have to drive in and out of Kumiu at peak traffic to find out what's going on when you put a whole bunch of people in a place that only has one road in and out. Silverdale and Orewa obviously into the city is another one, which is just a problem. And if they're going to put more people in Milldale, we've got a bigger problems coming up here in traffic wise. So what's coming? What's coming? Now this might, you look at this and you'll go, well, what's the triple CFA? The triple CFA is an act that's about to change your life if you want to borrow money in the future, coming later this year. There's going to be more questions around your finances, what you're spending, why you're spending it, and where you're spending it. So as a mortgage advisor, if you end up working with me in the future, I may be asking you more questions than you feel comfortable with, because I have to explain what we're doing with the bank. They want to know about your future debt ability to pay. So at the moment, the retirement ages kind of go 65 to 70, 70 to 75, or 75 plus. Most of the banks want you to pay your mortgage off by 70. So if we're going to be borrowing money and you want a longer mortgage term, which is going to take you past the age of 70 years, I have to now explain how you're going to clear that debt. And we need to talk about how you're going to clear that debt. Anticipated decreases in income. This is a crazy one where we need to now tell the banks, if you anticipate any decrease in your income in the next year or two. So if you're a young couple and you're thinking about having a baby, do you really think you're going to tell me that you're going to have a baby? Because it might affect your ability to get that loan. So it's a bit naive, some of these questions, but those are the questions that are going to have to be asked. And even more so now, they want to know what the purpose of the lending is for. And if you're refinancing, do you understand the cost of the refinance? Why are you doing the refinance, etc.? So it's not just about bouncing people between banks. It's about understanding and providing information around the cost and the benefits of what you're doing. So the other thing that's coming, more than likely, is debt to income ratios. And in Ireland, it's 3.25 in terms of your ability to borrow is capped at 3.25 times your income. In the UK, it's a little bit higher, and in New Zealand at the moment, we don't actually have one, but the banks control that other ways. And but ASB do have one, an arbitrary one of about 6 times income. So again, if you need to buy a property here, 6 times income might not cut it for you, and we'd need to take you to another bank to see what they can do. But these are probably coming. The government has given the tools to the Reserve Bank to use them if they wish. And then there's obviously maximum debt servicing as part of as a ratio of your income as well, or of your household debt. So they're trying to bring in these tools that are going to squash down house prices, is what they're trying to stop. They're trying to stop these things going up. So yes, we're probably reaching the end of this particular cycle in terms of price increases, but every 10 years in New Zealand, houses tend to double in value, or have done historically. Will that be the case going forward? Don't know, because we're in a different world now, a different type of economy, a different time. Probably will, because property is still a good asset to own. You can see it, you can touch it, it's there. Whereas the share market, if you invest in that, which people do successfully, but you're actually putting your money in the hands of someone else and hoping they make good decisions for that company to grow. And most companies on the share market at the moment are probably overinflated because people are investing in the share market because there's nowhere else to spend their money. So property will still continue to go up. It will flatten at this point in time, as Marcy alluded to earlier, but I think it's going to still creep, but it's not going to have this massive increase it's had over the past few years. The other thing that's coming, which or we think is coming, that the banks or the government's going to try and do, is bring in rent controls to stop rental prices going up, because they think investors are the big bad people, when in fact property investors are providing properties for people to live in. The government can't build them fast enough. The government can't manage them well enough. The government can't provide them. They need private enterprise to actually provide these properties to as a business, to give people roofs over their heads. I think they've got the wrong end of the stick in terms of trying to crush property investors. They stopped the market a few years back when they lifted the loan to value ratio to 40% for an investment property. They could have still, they've done that now, and they could lift it higher, and it would certainly dull down people's appetite for investment property. What they have done though is left the purchase of a brand new property at a 20% deposit, whether you're an investor, a first home buyer, or just anyone buying a brand new property. And what that has done is now has focused investors on first homes, on brand new properties, which means we're competing with first home buyers. And it means that that there's a problem in that area in terms of getting affordable housing for people. So I think their whole approach on the housing market, they've got it kind of wrong. So if rent controls come in, that could be another thing, and then restrictions on interest-only loans. So again, with investment property and people who have tight budgets, interest only is a great option, but now they're wanting to stop you having that for a longer period of time. What about the bank? Well, banks have what they call assessment rates. They're going to test whether you have the ability to service a loan based upon these particular rates at the moment. So the rate you'll pay will be less than this. Obviously, it'll be in the 2s or 3s at the moment. But so the banks always want to test you at a much higher rate to make sure you can afford the borrowing that you've got, because they know that rates will go up. They also know that life happens. Cars break down, teeth need repairing, kids cost money, and they want to make sure you've got enough fat in the system. They look at everything in terms of what you've got, and that's how we assess and work out whether you can afford this lending as well. So they definitely look at your spending habits. They're definitely looking at regular outgoings and student loans. So the things you kind of need to avoid if you want to be ready to purchase a property is excessive debt on credit cards, personal loans, Gem, Visa, Finance now. People have all sorts of things for all sorts of reasons. And part of our job is to help you clean the stuff up if you have it, so we can get you ready. Banks focus on different things at different times. And in this particular season we're in, they hate seeing these things down the bottom here. They hate unarranged overdraft fees. They hate missed payments. And they hate cash out on credit cards, because a cash out on credit card normally means you're out of money everywhere else. It's the only place you can get money from. And they always watch for that. So things to do, and especially tell your children this: get into KiwiSaver. And if they have poor spending habits, crank their KiwiSaver up to 8 or 10%. And that'll just force them to live off a lower income, and also force them to save. And just to manage their money, banks want to know if they're going to give you their money, they want to know that you're going to manage it, that you can manage your own money first before they give you theirs. So how do banks know this stuff? They know it through these things. They're looking at bank statements. They're actually looking at credit records. They'll do a credit check every time we place an application. So we don't spray applications everywhere, but they'll credit check you every time to see what your rating looks like, and if you have any interesting things in the background there. They'll also look at council systems and all sorts of things to see what's going on. So the tests are becoming more invasive. The credit checks are becoming more invasive. They will know if you're late paying bills. And again, that can affect us down the track. Some good news on the build front though. There's 2 banks that have actually stepped up and used some of the government money that's been provided to provide really good build rate in terms of an interest rate for if you're building a property. These are actually a floating rate, which could change, but this is the rate today. Westpac are countering this by offering what's called a higher cashback. So when we take you to a bank, we'll always negotiate a lump sum of cash for you. On a new build, Westpac are giving away $2,000. And on most builds these days, that'll cap out at around $15,000. So that's not a bad chunk of money to have. And it kind of can balance out between the low interest rate and the cashback with Westpac. The other banks aren't particularly doing anything to incentivize people in this area. So what's happening with rates? Everyone's got that question on their mind at the moment. Well, we'll come to that shortly, but in New Zealand, the maximum you can fix a mortgage for is 5 years. So you can fix a mortgage rate, you can float your mortgage rate, but you can also have different ways of floating that rate with what's called offset accounts or a revolving credit. And again, all these things are useful to know when you're coming to pay down your mortgage or when you're trying to manage a self-employed business. Break costs are a thing to be aware of, but they're not going to be an issue for the next few years because break costs only apply when rates are dropping, not when rates are going up. So if you've secured your mortgage, say at 5%, and rates have dropped to 2.5%, and you want to break your mortgage and refix, you'll pay a break cost because the bank will lend that money at a lower rate. But if rates are 2.5% and they've now gone to 5% and you want to break your mortgage, there'll be no break cost because the bank can lend that money at a higher rate. So I mentioned before that interest rates have tended to go down over the past 30 years, and this is the trajectory that Cameron Baggery pointed out a little while ago. This is one of his slides, and it just shows you where it's gone over the past 30 years. We've complained about interest rates for a long time, but really seriously at the moment, we've got no reason. Rates that are sub 5, we should be very happy with, regardless of where they are. And here's the backstory of what's actually happened over the years when we were used to paying much higher rates. And those of us who are a little bit older can attest to rates of 23% when we were first bought our houses. Yes, it was on a much lower value of borrowing, but it still hurt because our salaries were so much lower too. They're going up basically. And literally yesterday, 2 of the banks raised their rates a little bit. So they're starting to tweak them now. Come October 6th, we're expecting the Reserve Bank to lift the OCR by at least 0.25. By this time next year, all the predictions are they would have lifted it by 1.5%. So a 1-year rate a year from now is likely to be 4%, likely to be. Now that doesn't take into account what happens if lockdown goes longer, what happens if there are some other left field things that could happen in the economy. But at the moment, by all indications, and since lockdown last year, the New Zealand economy is romping and they're going to need to rein it in a little bit. So that's why rates will go up to curtail things. And this last slide will give you an idea of where rates have gone over the past 7 years. And you look at the OCR down the right-hand side, which is called the official cash rate. And that's the underlying rate that governs what banks lend at. It's actually the background rate that banks will settle their money at. So you can see we've gone down from fairly decent interest rates, which we thought weren't too bad back then, of about 5%, down to a 2.6 now. So again, by this time next year, this graph's going to look very different, and we're going to be back around probably 4% for a 1-year rate. So if you're looking to do something with your mortgage or coming off rates, talk to me quickly. Why would you use a mortgage advisor? Because we're totally independent. We'll give you more advice than a bank can or will give you. We're the constant face of the business. So if you find someone who's really good in the bank, they might not be there a year from now because they'll have been promoted. And plus, we're available. We'll come to your place and I'll buy the coffee. Thanks very much. If you have any questions or want to chat at some point, feel free to give me a call. And again, as I said, we'll find a decent cafe when we can and have a coffee.
Wow.